Every business needs money or financial resources to pursue the ranges of investment decision and acquiring ranges of assets in order to support the business activities that is ongoing. So, have you think about where are the money coming from in order to support the investing activities of all businesses at all times? Hello, I'm the expert tutor for financial management, Tze Kang Chan. The topic explainer, it's about asking and answering the questions on how money is being raised by all businesses by discussing the nature and the roles of financial market and institutions. The explanations regarding the nature and the roles of financial market, FM, and financial institutions, FI, will be mainly referring to the contents that found in the ranges of ACCA learning resources, primarily Study Hub, which is found on Chapter 2, Section 2.3, as well as 2.4. So by referring to the Study Hubs, guys, this is where that you can find the relevant contents of readings about financial market and financial institution, particularly the banking system, as well as the financial markets. Furthermore, ranges of additional materials, particularly the practice platform that will provide ranges of past examinations questions, practice exam, as well as the specimen exam will be there for you to get yourself familiarized in applying the theoretical knowledge into that, despite the fact it is yet to come with any of the technical article at this point of time. The explanation and discussions on financial market and financial institutions will be mainly referring to the following diagram in denoting and representing what exactly financial market and financial institution, as well as the role. Once we have seen the whole of the bird's eye view on this, the following illustration based upon ranges of past examinations questions will be demonstrated in the applications on the theoretical knowledge. Here we go. The financial markets or financial institutions would serve to be a very crucial fundamentals for all businesses organizations, which refers to the two of this main business entity, either it is unlisted or listed company. As we all know, at all times, every businesses require financial resources, money in simples. So they have to ask a very simple questions: where is the money coming from? In order to have the necessary financial resources in pursuing ranges of investment activity in acquiring the asset that require in supporting the business operation. Bearing in mind, guys, at all times, the value of the asset acquired by the businesses is always represented by the sources of finance that raised by the firm. So in other words, the amount of sources of finance and the value of asset is always be equal. In this part of the discussion, the fundamental knowledge will have to start focusing into understanding the types of the sources of fund and the types of investments on the assets that are acquired by the businesses. Knowing that there are two broad types of the sources of finances for all business, namely short-term finance, the money that will stay put in the firm for within a year, and usually such type of financing is appearing in the form of borrowing. In simple, that's finance. Secondly, finances that will stay put in the firm for more than a year, that's called long-term finance. In simple, it is called capital. Given that there are two main types of such long-term finances, mainly money that is coming from the owner of the business. For limited company, for instance, that will be from the shareholders. And these amount of the financing, including internally generated financing, such as retained earnings, all this money belongs to the business owner, and that is what we call equity. In addition to equity financing, it is common for businesses to raise long-term borrowings, and that is where it gives rise to long-term debt finances. Given the fact, other than short-term financing and long-term financing, let's not forgetting there could be other form of financing that may not be appearing in the statement of financial position. In simple, these are termed the off-balance sheet finances. Operational list or operating list, sale and leaseback, invoices counting, not to mention all, are among some of the off-balance sheet financings that is found in other part of the syllabus in financial management. Guys, once the money is raised from all these sources, so where would the money be going? And the answer, it's all found in the arrows that found in the middle of the screen. All the short-term debt financing are primarily be used in supporting the investments in the short-term assets or current asset alternatively. Whereas for capital, whether it is equity or debt, part of it will be used in financing the acquisitions of non-current assets, PPE for instance. In addition to it, certain part of the long-term financing will be used for investing in remaining part of current asset, and these portions of the long-term finance that invest in the current asset in general, it is termed the working capital. Guys, the purpose of this video is not so much in touching on investment, rather it is focusing into whenever the businesses is attempting to raise all the funding that we have mentioned, where would the businesses approaching? Where would they be able to raise such financing? And the answer, it's a market where there are supplies and demands that meet together. Businesses that require funding, it's obviously the demand of the financial resources. So where is the supply coming from? And obviously, it is coming from a group of people who has and possess additional financial resources that is ready to invest. And these are termed the investors. Places for both the parties that meet together, in general, it is called market. In other words, we call financial market. Guys, there are two broad types of financial markets where businesses manage to identify two different groups of investors. The first type of market is termed money market. This is the place where investors are planning to invest the money for within a year and it will get pulled out. And therefore, for businesses in attempting to raise the financing that is for short-term in nature, that is the place where the businesses will approach. So that's where money market comes in as an avenue, a place for the businesses in raising short-term financing. The other avenue of financial market, it's allowing the investors to invest the money for more than a year. So therefore, for the businesses to raise the money and stay put in the firm for more than a year that serve as a long-term financing. And this type of financial market, it's called capital market. So who will be there to get ready the money for the businesses to acquire? And the answer, as discussed earlier, the investors. So who are the investors that found in both the market? Firstly, the investors are mainly referring to institutional investors that are referred as financial institutions, in simple, FI. Not to mention all, some of the commonly seen examples are commercial banks, fund, and many others, financial company or finance company, for instance. So these financial institutions will be an intermediary that acting on behalf of another group of investor, which is in simple, it is termed the non-financial institutions. Example, individual investors, you, me, everyone as an individual, or it could refer to a wealthy individual, which could call as angel investors, and not to mention many others. There are two arrangements, two alternatives for the non-financial institution, the individual. to invest the money in both the market. Either these individual investors would have made a direct investment in both the places, the money market as well as the capital market. It is still also equally common that these non-financial institutions investors may have parked the money with financial institutions. And these processes give rise to an intermediation processes. By pooling the financial resources from the individual to ranges of financial intermediaries represented by financial institutions. You may be wondering, how would the individual investors may place the money with the institution investors? What are the instruments involved? And the answer is, it is common. Most non-financial institution investors, individual for instance, may be placing the money in short term with financial institutions through the investments in instruments such as certificate of deposit that were issued by banks. In other words, that's where the money from the individual will be deposited and invested with the banks. Alternatively, individual investors may have invested in commercial papers that issued by companies that is desperate in raising the fund, who has high credit rating through a middleman, which is one type of the financial institutions in the market. Last but not least, certain qualified investors may also be possible to choose to invest in another short-term instrument, which is a treasury bill, a security that issued by government of the countries for the attempt of raising the fund. Through these instruments of the investment, the individual investor will be able to place the money with ranges of financial intermediaries. That's where the financial institutions will have the money for the investment. So now, what happened to all this money? And here we go, back to the two main markets that I discussed a while ago. As far as the financial institution is concerned, which is here, it is mainly referring to commercial banks. It offers ranges of financial products for investors, for individuals to invest, as mentioned earlier, certificate of deposit. So with the money collected from the depositor, that offer an over-the-counter platform for businesses in the attempt of borrowing short-term fund. Overdraft, for instance, it's one of the instruments that businesses will be able to obtain from the money market directly dealing with the bank, which is what we call as over-the-counter. Apart from raising the fund in the short-term perspectives, what if businesses require long-term financing? That's where it will then approach the capital market. As mentioned a while ago, this is the place for investors that is ready to park the money for a long-term investment instrument. At the same time, for the company that require raising long-term financing, that's the place which they will go. Bear in mind, there are two alternative platforms in capital market. One, it refers to over-the-counter. Who are they? In simple, the over-the-counter, it still refers to a type of financial institution, primarily commercial banks, where the company may be allowing to take up long-term bank loans or term loans that lasting for 3 to more than 30 years of the bank loan. That is a kind of over-the-counter capital market. In addition to that, here comes another much bigger and important platform of capital market that is termed as exchange traded, namely the security markets. That's where all qualified investors, not to only restricting to financial institutions, but also non-financial institutions, individuals, for instance, will all be allowed to invest into ranges of securities that are found in the market that issued by largely companies that are listed primarily. Guys, that gives the most fundamental understandings on the two main types of financial market: money market, capital market. Bearing in mind, both the markets in this platform is playing a role to provide businesses, particularly listed company, in raising funds. With this kind of role that serve for businesses to have an avenue for fundraising, these are the key roles of the financial market that is called the primary market. Let's take on further to understand a little bit further regarding security market in N1. Security market is simply referring to stock exchange in most of the places in the world. That is a place where the issuer of securities, it can refer to the issuing of shares, ordinary shares, preference shares, just to mention a few. Bonds, or alternatively, it is termed loan notes, and many other securities that may be issued by the listed company for the attempt of raising funding. When these securities were issued in the stock exchange, that's where it attracts the investor, as mentioned a while ago, to acquire the security by pumping in the financing or the money to acquire the security. And this money will then transform and convert into capitals that injected to listed company in return of the issuance of the securities that become the share or the bond that issued to the investor who acquired it. And that is what we have mentioned a while ago, when the stock exchange, which is a security market that is playing a role to provide as an avenue for company in raising funding, that is what we call the primary market. However, it is worth taking note, there's another role that security market or stock exchange in many parts of the world are playing, namely secondary market. So what exactly is secondary market refers to? That simply means this is the same place, this is the same avenue for all investors to materialize, to realize the gain by disposing of the securities before the maturity period, if there is any. How do they do it? The answer is they may allow to dispose of the securities, shares, bonds, many others, to other investors in return for the proceed based on the market price at the point of time. When the securities sold and transferred from one investor to another investor, that represents a second-hand market that serves in the stock exchange. That is what we call secondary market as such. It is this role of the secondary market that make the stock exchange such an important platform and avenue for both the investors and the company that is very tempted to meet each other at this place to meet each other's financial objectives. So, after looking at the broad pictures of all types of market and financial institution, it's time for us to take a summary to understand the nature and the roles of both the entity. The financial markets, denoted by FM, it simply refers to, as discussed a while ago, the money market, which is mainly over-the-counter, as well as the capital market that can be over-the-counter as well as exchange-traded. Here are the roles. Here are the key roles that what the markets are serving. They provide ranges of precious investment opportunities for all kinds of investors in all the markets that discussed a while ago. It also provides an avenue for fundraising for all businesses, particularly when it comes to exchange traded. That only applies for listed company. Other than that, this is the avenue that is available for all businesses types for raising the necessity of the financial resources. Thirdly, this is also the place that offer ranges of financial instruments for both the investors and the businesses in managing and mitigating the risk that is existing and arising alongside with the business activity. Last but not least, by going through ranges of financial institutions, primarily it refers to banks, it may allow the government to implement the monetary policy as set at the point of time via manipulating or adjusting the interest rate that's set by the banks. And these are therefore the main roles that served by the financial market. Guys, it is worth to take note as an update for everyone. These markets nowadays can either be classified as domestic or international. That simply refers to when country A is having such market that transact all the investment and the sources of fund denominated in the currency of country A, that is what we call domestic market. Whereas, if country A is providing this platform in the market for investment of financing resources and raising the financial resources from the businesses, not in the form of currency in country A, but it is in other form of currency that provide a platform to have an international financial market. In simple, it is called the euro currency market, which is far beyond the part of this topic explained in the video. Other than the roles of the financial market, let's take a look at the roles of financial institution. In simple, the financial intermediaries. Guys, here are some of the key roles. Aggregating financial resources, pooling financial resources is one of the major roles that play and served by the financial institution as discussed earlier. Transforming from one maturity period to another maturity period. In other words, maturity transformation is another functionality of having financial institution. By providing ranges of financial instruments, as mentioned a while ago, it offers opportunity for investor for diversifying and reducing its risk. Furthermore, it provides both the entity, the investor, and the businesses who need to raise the fund a flexibility of raising fund with high degree of liquidity. Last but not least, providing ranges of financial instruments for both the party that offer a great opportunity of having ranges of hedging instruments that use for risk management for both the parties. These are therefore the main roles of the financial institutions all the while. However, it is worth to take note, the above roles of the financial institutions traditionally has, however, been disturbed as a result of the emergence of fintech that's supported by the creation, the innovation of disruptive technology such as blockchain. Again, that is far beyond the discussions in this part of the topic explainer. So guys, it is time to show you some demonstration and illustrations on the theoretical questions that found in financial management examinations pertaining to this particular topic. It is worth to take note, whatever that you see in financial market and financial institutions are mainly examined in the form of multiple choice questions. And at this moment, with all the sources of the questions that found in the practice platform, there are two. However, I did not say it is only confined to these two, but there are two broad categories of multiple choice questions pertaining to this area. First, the questions is testing on and asking on the roles of either financial market or intermediaries. Secondly, it is about asking the types of financial instrument that is available in different types of financial market. Let's take a look at some of these multiple choice questions. Type 1, first questions. Which two of the following activities are carried out by financial intermediaries. That was exactly what we had discussed a while ago. Guys, pause the video and give it a try before looking at and listening to the rest of the part of explaining the answers of these questions. So what is the answer? Which are the two of these activities that will carry out in the financial intermediaries? And the answer is obviously transforming maturity and transforming the risk, as discussed a while ago. And that is exactly serving the purpose to have these financial intermediaries that placed mainly by financial institutions. Let's take a look at the second questions asking on roles. Which of the followings are usually seen as the purpose and benefits of having financial intermediation? Do you notice it is similar as comparing to the earlier questions that we have, but it is reworded in a different manner? So, what's the answer? Again, it is worth to take a pause before listening and looking at the answers in the part of the video to come. And what's the answer, guys? And the answer is still talking about pooling of risks and transformation of maturities to be the benefits to have the financial intermediaries, intermediation processes. So these, it's all about tackling on the roles of either market or institutions. Let's take a look at the second type of the questions that is asking about types of instruments. First, indicate by clicking on the relevant box in the table below whether each of the following financial instruments are traded on financial market, particularly the money market. Do you still remember? Money market is a platform, is an avenue for investors and the businesses will need to raise the fund that meet together that is achieving the investment opportunity and financing resources that is only lasting for a short period of time of within a year. That is the key point. So by looking into the four items of the financial instrument, what you should pick up, it's the instrument that is only found in short-term maturities periods in nature. And from there, that will allow you to have a higher chance to find the correct matching by choosing the right combination. So guys, take a look at the four instruments. Which are the instruments that is serving as a short-term financial instrument as discussed a while ago? And the answer obviously is commercial paper, treasury bills, certificate of deposit. These are the three typical type of short-term instrument that is mainly traded in money market as such. Obviously, convertible loan notes, it's clearly a long-term instrument that has mentioned a while ago. In other words, convertible bond. So, here is the answer. As a result. Let's take a look at the next questions. Which of the following instrument that company Max should issue? Again, it is asking for instrument, financial instrument. Take a look at the scenarios as mentioned and discussed above. M, Max company, is large multinational company that expecting to have so much of cash deficit in a month's time. The shortfall of the cash is only expected to last for no more than 2 months. That is an indication of they need short-term financing. So as a result, as what the question say, in resolving the short-term liquidity problem, they would like to raise the fund through the issuance of the following instrument. So which are the instrument that is serving as a short-term instrument that suitable for businesses or company for raising short-term funds? Guys, do you still remember what we have mentioned? It is these two instruments that we will discuss about short-term instrument a while ago. But the difference of these two is that treasury bill is the instrument issued by government mainly for raising short-term fund. it is only commercial paper that were issued by corporates or businesses for raising short-term funds. And therefore, that's the answer. Finally, here's another question that's asking for instruments about which two of the following statement is true about the feature of money market instruments. So again, it is mainly focusing on short-term instrument. Take a pause and make a guess on the answer before looking at the rest of the video over here. So guys, which of it is a feature of money market instrument? And the answer is the first and the third. These are the main instruments that carry two of these features that found in the money market. The rest of the details for the explanations can be found in the study hub as such. I hope with this video that gave you a better understanding, a more systematic understanding regarding financial market and financial institution, and more importantly, the way to apply in answering the questions. With that, take care and good luck in your exam.